Hello, everyone, and welcome to part 2 of HerCapital's personal finance series in partnership with Aspiriant. For those of you who joined us for part 1, welcome back. And to those of you who are new, we're so excited to have you. Today, we'll be covering step-by-step how-tos on investing. We'll cover the mechanics of how to build outperforming portfolios and also give you a couple of refreshers from last time's session. For some background, I'm Sabrine Khan. I'm one of the co-founders here at HerCapital. Outside of my work with the organization, I work here in New York City at a venture capital firm investing in technology businesses. Here is my co-founder, Rabia. I'll let her introduce herself.
Thanks, Sabrine. Hi, everyone. Thank you for joining. As Sabrine mentioned, I'm her co-founder. My name is Rabia. I work in the public market space, focusing on institutional investors and helping them invest their money.
If you are going to be posting about today's event, please use the hashtag HerCapitalXAspiriant and feel free to tag us. On Instagram, our handle is @her.capital.
For those of you that are new and joining us for the first time, Sabrine and I, after spending several years in finance, decided to start HerCapital, which is a nonprofit organization with the mission to empower women to invest in their future. We hold online events like this one, for example, as well as have an online knowledge base on our website and more bite-sized content on our Instagram and also on our Twitter. All of this is done in an effort to try and help women take control of their income and learn more about investing in personal finance. For this particular event, in fact, for this series on personal finance, we have partnered with Aspiriant, which is a leading wealth management firm based in California. And our speakers today are Lorraine Fox and Lydia Waltz. Thank you, ladies, for joining us once again for part 2 of this series. Lorraine and Lydia are phenomenal and are actually experts in the wealth management space. And both women share our passion for helping women invest and for teaching women the basics of personal finance. Thanks, ladies. I will let you guys introduce yourselves and also give an overview of the agenda, and then we can get started.
Okay. So I'm Lorraine Fox. I'm pleased to meet everyone, and thank you again, Sabrine and Rabia. We definitely do love partnering with you. We think financial education is important to women in particular, and we'll get into some of the reasons why, but we need to educate and empower. Women actually, when they do invest, some studies show that they do better than men. So let's get educated and get going on this. It's a very important introduction. I'm a partner. I serve on the board of directors at Aspiriant. I've also been in venture capital. I've been a marketing exec at tech firms. So I have a pretty complete background and experience with personal investing as well. It's not taught in school. That's why we think it's so important to learn some things now. And with that, I'm going to turn it over to my colleague, Lydia Waltz.
Thanks, Lorraine. And thank you again to Sabrine and Rabia. It's such a pleasure to be here. I love all of the content you guys produce. It's been an education for me. I graduated from a women's college, Bryn Mawr College, in 2016 and came out to San Francisco and kind of fell into the industry as an administrative assistant. And then as I learned more about wealth management, I realized how achievable it is for the average person who maybe didn't study it in college, and made my way over to Aspiriant, and I've been there for about 2.5 years, and it's been a wonderful education. So let's spread that a bit. So we're going to start off with some reminders from the last session. We are interested in knowing if any of you attended the first session that we had on YouTube last time. So if you have, and if you did, please put a 1 in the comment box below. We're just curious. It won't matter if you didn't. We'll do a small review, and then we'll cover things that are separate from what we covered in the last series, so feel free to stick around. Don't feel you need to watch that one. So also moving into today's agenda, we're going to have some reminders, as I said, from the last session. Oh, wow, a bunch of people. Wow, I'm just getting all of these lovely comments. Welcome back to those of you who are who came to the first session, and welcome to those who are new. So some reminders from the last session. We are going to discuss some savings pointers, and then we're going to take a deeper dive into some of the investment vehicles. What are they? How do some of these different vehicles work? And then I'll pass it over to Lorraine, who will take it away with some asset allocation and opening accounts. After that, we're going to try to leave plenty of time for Q&A. We want to answer your questions. So let's get started with our review. So cash reserve is one of the main things to start building right off the bat. So you're going to have two buckets. One is going to be the emergency cash reserve. Ideally, this is about 3 to 6 months of your basic living expenses. Now, what do I mean by basic living expenses? That's going to be, you know, your rent or your mortgage payments, utilities, groceries, the things that you need in order to continue to keep a roof over your head and fed, not so much considering, you know, dining out expenses. Then the other cash reserve you'll want is a savings for your nearer term goals and expenses. That vacation you want to take when travel restrictions are lifted and it's safe to go out again. Those funds are best saved in cash because the investments are volatile and you might want that sooner rather than later. So once you've built up your cash reserves, you can get investing. So investment accounts should be designed and designated for goals that are 5 or more years off. When you buy a security, it's ideal to hold it for at least a year to let it grow. That way you get preferred capital gains treatment on some kinds of accounts. Even if you're trading in a retirement account, which doesn't have trade-related tax concerns, you still want to be conscientious about any transaction costs associated with making the trade. It makes sense to try to at least break even on that initial cost, and Lorraine's going to go into what I mean by that more in a bit. But most importantly, keep in mind that investments don't just go up. This is why you want to give the security some solid time to move with the volatility of the market before you need to tap the funds for your goal. So retirement accounts is a third bucket here. It is also an investment bucket. This is a sub bucket. Retirement accounts are set apart from regular brokerage accounts due to their tax treatment. A reminder, the traditional or pre-tax IRA or 401k doesn't require you to pay taxes on the funds you put into the account. Rather, they tax the proceeds when you take the money out of the account at retirement. From the perspective of the pre-tax retirement accounts, the IRS doesn't haircut the funds you put in there, so you can get momentum on the investment. On the other side, you've got your Roth IRAs and 401ks. Those do require you to pay taxes before you deposit the money, but then the funds grow and are never taxed again. The whole point of the tax timing is to fuel long-term growth in the investment. For the Roth accounts, any gain you make in the account is 100% yours and you won't owe taxes on that growth. In this way, you have a larger rate of return to keep for yourself. So that's a pretty powerful tool. But this all brings us into why investing now. This is called the power of compounding interest. And while you may have heard of compounding interest before, I'm going to define it for you. So what does it mean? Year over year, you earn some kind of return, whether it be positive or negative. The idea of compounding is considering that if your returns were positive last year, that means that you have a larger base off of which to make another return this year. If you have a long time horizon on your investment and high returns over the course of that time, you stand to make a substantial gain. So let's look at a visual. Let's look at an example of this. I'm going to draw your attention to Chloe in the blue and Noah in the green. So Noah has saved from ages 25 to 65, 40 years. He saved $10,000 a year. So that equals $400,000 total. Good job, Noah. He is keeping it in cash. and that cash account is earning about 2.25% every year, compounding. At 65, when he's ready to retire, he's going to have that green circle there, $652,214. That's some nice growth, the difference between 400,000 you put in and 652,000. But now let's look up at Chloe. She invests from ages 25 to 65, the same time span as Noah, and the same amount as Noah. She put in $400,000 total. She earns 6.5% year after year after year. And now that's an average, that's annualized. So over the course of her time, she earned 6.5% every single year. And that came out to 1.87 million. That's a major difference between Chloe and Noah. So I'm just impressing to you the importance of compounding interest and getting that return and getting involved in the market to get those returns. So I want to know from you in the comments, please, what kind of investments are you familiar with? Stick it in the chat. You might have heard of equity investments, stocks, bonds, mutual funds, ETFs. I'm curious what you know about. I'm aware that there's a small lag between me getting the comment. So in the meantime, we might take a quick review on stocks versus bonds. So if you are a stockholder, stockholders have paid for and now own a portion of a company. So this is something to consider on the next slide. Oh, yes, sorry, I'll go through the, oh, hey, I'm getting some answers here. Index funds, ETFs, mutual funds, stocks, ETFs, stocks, bonds, and mutual funds. This is awesome. All right, people have really heard of the mutual fund. This is awesome. Fantastic. All right, so you guys know what's going on here. So we're going to dive a little bit first into stocks and bonds. And first I'll start off with the fancy names for stocks, which is equity, and the fancy name for bonds, which is fixed income. If you hear these words, they likely mean either stocks or bonds. So the stockholder has paid for and now owns a portion of a company. As an investor in stocks, they expect a payment in the form of a dividend, but more importantly, they're hoping that the company's perceived value will go up. This means that people might be willing to pay more than the actual value for a portion, a share of that company in order to get in on the growth. If the company is popular, the investor might be able to sell their share at a profit to someone else down the line. On the other side, you have a bondholder, and we're going to go into more detail on bonds, but bondholders have made a loan to a company to help them run their business. So as the investor, you are also the lender. And as the lender, you expect back interest payments on the loan you made to the company. And at the end of the term, the company is going to pay you back your principal, that loan amount that you gave them. So a bit of a history lesson here. Back in the day, if you went out and bought a stock, you would receive a stock certificate like that one that you see. You can still get these, but you're more likely just to now log in to your bank or investment account that's accessible online and check how your stocks are doing and the value. Also, we now have Yahoo and Google Finance, or Morningstar. And these are websites that tell us the daily value of the bonds and stocks, mutual funds, along with important reporting dates for the company and their historical values and the performance of the securities. So let's pop into what bonds are real quick. So I'm going to the first bullet point here is, I think, the most important. I'm going to start off with an analogy on bonds. When you buy a house, you might get a loan from a bank to help you with the cost of the home. This is going to be called a mortgage. The bank will give you the loan, and then you are responsible for paying interest on that loan. In the case of a bond, you are the bank lending the company money to pay its employees, to help them buy a new piece of equipment, to pay rent on their office building. They can use it for whatever they issued it for. They will owe you interest back, and eventually they will pay off the principal in a lump sum at the end of the term of the bond. So yes, you get to charge them interest on the bonds. It's money you lend them. So what's important to watch on bonds is the interest rate. Interest rates are set by the Federal Reserve. And if the Fed thinks that we're in a strong time in the economy, they're going to raise interest rates because people and companies can probably pay higher interest rates since the markets are doing well, right? There's more money. On the other side, when the economy is headed towards recession, the Fed will lower interest rates in order to make loans less expensive, make money cheaper. You might have heard about this happening recently when the market dipped in March. Having a low interest rate makes money cheaper to borrow. This is true for both people and for businesses. So different bonds will have various interest rates based on where the interest rates are set when the bond is written. From the perspective of the bond owner, the higher the interest rate, the better, because then they get a higher payment back, right? You get a higher interest. If you own a bond with a high interest rate, and like right now, it's a low interest rate environment, it's hard to get high interest rate bonds, then you're going to be able to sell your bond to another person at a premium. So for more than maybe it would be worth if it was paying less. So as interest rates go up, bond prices lower. As interest rates go down, bond prices rise. Okay, that's kind of an important concept to grasp. So I hope you're with me on that one. But we can also go into ETFs, which a surprising number of people have heard about already. So an ETF is a security that is going to track an index. So you might have heard of the S&P 500, the Dow Jones are two. Lorraine's going to go into much more detail on indexes, but they're going to track an index, and its performance will be tied into the performance of the index it's tracking. So since it's not managed like a mutual fund, it's cheaper, but potentially more volatile depending on what the market is doing and where the market is going. So lots and lots of people have also heard about mutual funds. Well done. So these are combinations of securities that are wrapped up into, choose your food analogy, a casserole, a burrito, a sandwich, of different holdings. So it's a whole pot of different holdings. There are some, and holdings, I mean stocks, bonds. And so there are some mutual funds that are just different stocks or just bonds. There are some that are a combination of the two. These funds are usually managed by fund managers who choose what they think are the best combinations of those securities for the purpose of the mutual fund. So a popular type of mutual fund is a target date retirement fund. So say I was going to retire in 2060. I have a long time horizon. So right now, if I bought that target date 2060 fund, it would likely be mostly equities, stocks. But over time, as the date got closer, it would probably include more and more bonds to help it be less risky. It's important to remember that since you're buying a package of different securities, and since it's managed, these can be a little more expensive. Ideally, the better return in the market as a result of the management helps you break even on your fees faster. Further, it might be less expensive, not to mention less work, to buy one mutual fund than to buy all of the underlying securities that you could find in that mutual fund. It's a little bit of a package deal. Overall, mutual funds can offer wider asset allocations on a single purchase than any other security that I've named. But Lorraine is going to go into more detail up next on what asset allocation is and why it's important to understand.
Very, very good introduction. So what we're going to do in this next session is talk about asset allocation, how you build a diversified portfolio, what are the components of it, how you manage risk and returns, and then how you open an account, and then we'll go into live questions. So for asset allocation, we have 5 main asset classes that we're going to discuss. 2 of them Lydia just spoke about: fixed income, which are bonds. They can be corporate bonds or they can be government bonds. Equities, which are stocks that give you exposure to the real economy, and equities are the source of long-term growth. Diversifiers. Now, this is a more interesting asset class that you probably haven't heard of. But what we're trying to do here is build a piece of the portfolio that is not sensitive to interest rate risk or equity volatility. So typically this type of asset won't go up and down just as stocks do, or as fixed income does when interest rates change and then bond prices change conversely. So this is an important part to kind of stabilize your portfolio, produce good returns over time. Some examples of these types of funds, and you'll find them in large portfolios. We tend to make them available to the individual investor too, but you can have absolute return funds. You can have what's called a long short fund, where you take a position in the market, but you're not 100% long. So those are, or benchmark free funds, so that they can shift around without being held to a specific benchmark, like 60% equities, 40% bonds, which is very typical. And the other two asset classes are real estate, which we call real assets. So this is a good inflation hedge. One thing about investing is one of the purposes of it is to stay ahead of inflation. And we normally think of inflation as 2% annually. So when you compound, going back to Lydia's compounding example, if you compound 2% over a period of time, you'll realize that the purchasing power of your dollar today will not be the same as the purchasing power of your dollar in the future unless you're staying ahead of inflation. That's a very, very important point, and one of the arguments for why people shouldn't stay in cash. You're basically going to lose money over time. Even though it feels safe, it's actually not safe. We also have a class of equities called defensive equities, and this allows you, these type of equities allow you to stay invested over the long run. So what is an example of a defensive equity? They tend to be large companies. They tend to have pretty predictable earnings streams because, the best predictor of a future stock price is based on earnings, a company's earnings. If a company can't grow, if a company can't produce earnings, their stock price will fall over time. So good examples of defensive equities: Microsoft, Google, Apple, Johnson & Johnson, Procter & Gamble, companies like that tend to be more predictable and stable. Okay? So what are the benefits of asset allocation? I think probably everyone has heard the expression, diversification is the only free lunch in investing. So what that means is if you have a basket of assets that aren't highly correlated with each other, meaning they don't move up and down together, you will be able to manage risk and produce the most predictable returns over time. So asset allocation is not about stock picking. It's about combining these assets that we talked about: fixed income, global equities, real assets, defensive equities, and diversifiers. So you combine them into a basket that's going to work for you over a longer period of time and therefore control risk. And once again, risk and return are related in the long run. So let's look at this chart. And what I want you to take away from it is, on the very left, those are one-year returns and the variability of different asset classes. So the blue means stocks or equities, the orange is bonds, and then you get what happens when you combine stocks and bonds in a 50-50 portfolio. So if you look at the variability of equities of stocks over a one-year time period, my goodness, it can be anywhere from minus 43% up to a positive 61%. That's a huge dispersion of returns. Where if you go over to the very right-hand column, you'll see, again, 100% equities, 100% bonds, and then the combination 50-50 of stocks and bonds. And the combination, again, Now, these are much more stable. The longer you go out, they tend to revert to the mean, these annualized returns. So -3 to a positive 19% in equities is a much smaller dispersion than a -43 to a 61. So again, we want you to try to be long-term holders of these portfolios. That's the main goal here. And the longer you hold them, the more you can manage risk and return and get some predictable returns over the long run. So let's look at returns across asset classes. Like we saw in the previous chart, global equity and fixed income, they tend to oscillate between the highest and the lowest returns, while defensive strategies, the uncorrelated asset classes, and also a global balanced portfolio of 50% equities, 50% stocks tend to be the more consistent over time. This chart actually shows you a variety of equities from US large cap stocks to emerging markets. And you can see between 2001 and 2019, you can never predict which one of these equities is going to be the high performer over time. So one can start out as a top performer in 2001 and then be the worst performer the following year. That's why, again, you want a combination of all these to stabilize your returns over the time. And this is why you hear the expression, don't put all your eggs in one basket. So let's try to construct a portfolio. We'll give you three examples here. And what we want to do, CPI is a measure of inflation. And when inflation is 2%, and you always want to construct a portfolio to stay ahead of inflation, if, say, it's your grandmother's portfolio and she's in retirement and she wants predictable returns over time, she would probably want a more conservative portfolio. So she's staying ahead of inflation, but she's not taking a lot of risk because she's living off of her portfolio in retirement. So a conservative portfolio, we kind of target at CPI, inflation plus 2%. So a return of 4%. And there will be some variability, but again, the dispersion is pretty small. But you would have a lot higher percentage of fixed income and diversifiers in this portfolio and a lower percentage of exposure of equities in this portfolio. So you're going to get some growth over time, but it'll be pretty managed growth. A moderate portfolio is obviously in the middle. If you don't need to take a lot of risk, you still have a pretty long time horizon, and you can beat inflation plus 4%. So that's a 6% nominal return. You'll take a little more risk. Your returns will be a little bit more volatile over time, but you can see you have a much higher percentage of equities and a smaller percentage of fixed income. And then if this is your first job, say, and you're investing your 401k for the first time and you're 23, 25 years old, you have a long period of time. You can handle the volatility of a growth portfolio, and you will do better over time because you'll beat inflation by 6%, so a nominal return of 8%. And you can see you have your largest allocations to equities and a very small percentage to fixed income. So that's how we look at portfolio construction across asset classes, and that's when you see your 401ks, for instance, and you have a menu of investment choices. We would recommend, again, having more allocated to global equities and defensive equities, a small percentage to fixed income and diversifiers, and real assets, real estate in the form of real estate investment trusts. So how do you know how you're doing when you construct a portfolio? This is a very, very important question because I think it's common for just about everyone to look at the return and say, did it go up or did it go down? And they judge the portfolio accordingly. If it went up, it's good. If it went down, not so good. But what you really, really need to do is compare the returns of each asset class against a benchmark. So look at your asset class returns and compare them to the relevant benchmarks. And then you'll be able to say, like, did I make good choices when I invested in fixed income? Or should I have just invested in the Barclays Municipal Bond Index, or the US Aggregate Index, or the High Yield US Corporate Index? So those will let you know whether you can take more of a passive approach and just invest based on indices, or whether you think you have the ability to beat an index, which is very, very, very difficult over time. The best investors have a difficult time beating benchmark returns. Again, in global equities, the most common index is the MSCI. It's what's known as the ACWI index. So that's a global index. Then there's one that just captures developed economies, Europe, Asia, Far East. That's the AFI. There's a small cap index. There's an emerging market index. And then we have either an S&P 500, you've probably heard of that, a Dow Jones index, a Russell 1000 index, or a Russell 2000 index. So again, we want to do comparisons across asset classes so that you can tell if you're doing better or worse than the appropriate index. Now let's talk about how to open an account, since you know how to build a portfolio now. So Lydia mentioned this too. There's a passive approach to investing and there's an active approach. Passive is if you just want exposure to an index. So say I need exposure to US equities and I'm going to get that by buying an S&P 500 index. That gives me a little bit of exposure to 500 companies. And that's a much better way of managing risk than putting all your eggs in one basket and saying, I'm just going to invest in Tesla, say. An active approach to investing is where some skilled investors try to outperform a particular index or benchmark through their selections, buying and selling, etc. So a mutual fund, there are active mutual funds which you can choose that do that. A low-cost active mutual fund that we think of as very high quality is Vanguard. So let's talk about fees. There are 3 different kinds of fees. The first one is your net expense ratio. Now in an ETF, the fees are much smaller, and that's related to just the administrative cost of running that particular fund. But you also have transaction costs. So if you buy and sell, there are transaction costs associated with each trade, and that's usually a dollar amount. You know, some securities and some indices, ETFs and mutual funds may be offered free of transaction costs, but you just have to make sure that you understand what fees are associated with your portfolio. So transaction costs are also, you know, that's the second kind of cost. And then the third cost would be an advisory fee. So if you pay a professional to help you with your personal finances by, you know, creating a plan, matching the results of your plan against a particular type of investment portfolio, you'll pay for that advice. And that's usually, and you do that either with a robo-advisor or with a person like Lydia or myself. And it's usually 1% or less of the assets that you're having managed. And it's usually expressed as a basis point. So what is a basis point? Because you'll find this if you get a mortgage too. So you multiply the percentage times 100. So 1% equals 100 basis points, and 25 basis points is 0.025%. Okay, let's try to set up an account then. Think about who's the owner of the account. So if you're single, you want to set up the account in your name. If you're married and the funds are joint, then you may want to set up the account in both names, but you have to be very aware of state laws, because in California, for instance, everything is community property. where as in New York, it's set up as a tenants in common, and there are ramifications of the way your state laws work. And then if you're not married, but you share expenses with a significant other, then we would recommend keeping things separate until you are legally married. But it's perfectly fine and probably recommended to have a joint checking account so that you can make expenses, you can deposit and pay off combined expenses. So, if you split rent, if you split, your groceries, your utilities, et cetera, then at least, you're both contributing and those expenses will get paid out of that joint account. Okay, I think it's time for live Q&A, so we're looking forward to answering your questions.
Hi everyone, my name is Katie and I'm a member of the programming team here at HerCapital. Now we'd like to move on to our Q&A segment, so please continue to ask your questions in the chat and we'll try our best to get to all of them. So for our first question, can you explain what online stockbrokers and robo-advisors do and what are the differences between those two platforms?
Yeah, I can take this one. So online brokerages and platforms, they're just different places that you can open up an account. So just naming a few, there's Schwab, Fidelity, TD Ameritrade. There's also Wealthfront or Betterment. So segmenting these, the Wealthfront and Betterment are robo-advisors. So this is a place where you could go and set up an account if you wanted some other thing to invest for you. Robo means that there's probably some algorithm that they're going to use based on what is called a risk tolerance. And they have you set your risk tolerance, and they'll ask you a few questions like, how much would you be willing to lose of this money under these certain circumstances? How quickly do you need to use this money? And that will help them. And how would you feel in a downturn? And that will help them understand what ratio perhaps of fixed income to equities is appropriate for you. And so that would be a robo-advisor. They are going to invest for you. All you have to do is open up the account. On the other side, there's Schwab and Fidelity. Vanguard is one that was mentioned in the chats here, and that's also a platform. I'm not naming them all. Please do your own research on the different brokerages. But that's where you can go, you open up an account, and then you can continue and actually select the securities that you're interested in investing in. So you can buy mutual funds and buy stocks, individual stocks or individual bonds or ETFs if it pleases you in those accounts. And so importantly, you open up an account and then you trade within that account. So there's sort of two sections. So you can own a mutual fund in a retirement account or in a regular brokerage account. That's how that would work. And so there's account, and then there's what the account owns. It's important to keep that in mind. But yes, so I think Investopedia is a really great place to go to research some of these different things. NerdWallet also has a great list of different brokerages where you can sort of see what the different service offerings are. They're very objective.
Great, thank you, Lydia. For our next question, this is specific to the current COVID-19 era, but what are some key tips you have for people who are investing during this pandemic, possibly investing for the very first time?
Okay, I'll take this one, Lydia. So again, if you're investing for the very first time, we always don't invest in a vacuum. Really try to identify what are your goals, your financial goals, short and long term. So say you're investing the first time in your 401k, in your retirement account where you have a very long time horizon, then I wouldn't be that sensitive to what's going on now because we'll get through this time period. And again, the basics of portfolio construction apply. You'll need some exposure to equities if you want growth, and that means the global economy. You'll want something that isn't as highly correlated with equities like fixed income and diversifiers. You'll want a little bit of real estate in the form of an REIT to create an inflation hedge. So you'll want exposure to all those asset classes so that you can meet goals over time. And I'm really speaking with long-term goals. So try not to let the current environment influence you more. We'll recover from this. Economies go in cycles, and it usually is about a 7 to 10 year cycle. So the most important thing is to be disciplined. If you're dollar cost averaging in, like making some investment every month, just be very disciplined about it. Try to stay on your asset allocation and keep going.
Katie, I think you're muted.
Thank you. Sorry.
Happens to us all.
In regards to portfolio construction, how would you guys suggest college students in particular to think about asset allocation?
I'd take this one. So actually, Katie, are you able to bring us back to slide 24? Or Elizabeth? So in that slide, we saw a conservative, a moderate, and a growth option, different columns. For young people, keep in mind that you have a really long time to be investing, particularly if you're investing for retirement. So it makes sense to embrace the growth orientation of things. So I would say, don't hold only fixed income. Never hold just one thing to start, but also consider holding a little bit more global equity. And what I mean by that is maybe try 70%. But a 60-40 portfolio is usually what's considered middle of the road, moderate. You could probably afford a little bit more risk for long-term things. Just remember, though, that all of this is really based off of what we talked about risk tolerance. How are you going to feel if you see the accounts drop? How is your discipline going to be? Because what's really important that you don't do is see a drop in your accounts and then try to cash out, because then you're just selling low. And as you may have heard the saying before, buy high, sell low. So it's going to feel a little counterintuitive to try to buy when things are cheap, maybe buy the unpopular thing, buy the out of style fashion, not to necessarily make this about fashion, but then try to sell it, when it gets popular. So keep in mind that it's nice to have a little bit of exposure to global equity when you have a long time horizon.
Awesome. Thanks, Lydia. Continuing with that portfolio construction line of thought, what factors should we take into consideration when selecting individual companies for our portfolios?
Yeah, I'll take that. First of all, we don't recommend that. If you want to, when you're constructing a portfolio, we want you to get exposure to broader asset classes. If you want to play around with a couple of stocks and just see how you do, I would do that in a separate account, and just personally manage it yourself. But you really, again, want to be very disciplined about the categories of how you invest and avoid single stock exposure. You expose yourself to a lot more risk. So if you're building something, again, you want diversification to take hold. You want defensive equities. You want global equities. You want diversifiers. You want some fixed income. You want to be able to have all of your asset classes not move in the same direction with each other, not be highly correlated. Otherwise, when things go up, you're going to go up, and then your entire portfolio is going to go down. You want to avoid that. You want to have some consistency over time and avoid taking huge losses.
That makes sense. Thank you, Lorraine. For the next question we got, it was, would investing companies combine different accounts you have with them, such as mutual funds and retirement accounts?
I can take this one. So from the perspective of what you actually see, you'll probably get a dashboard That's pretty normal, just if you have multiple accounts. And they'll be listed as what type of account they are. So remember, this is the difference. These are the different buckets. So you'll have, let's just say, a Roth IRA, a retirement account. And you might have a non-retirement account called either an individual account or a brokerage account. This is for money that you've taken out of your savings account and decided to invest it, and bought some stuff in there. And so then underlying that, you'll have the holdings that are in each respective account. So say you did want to just try and buy one or two securities just to see what it feels like individual stocks. You might do that in your Roth account. And you can trade around in there without worrying about incurring any taxes back to you. And then this is, again, suggestions, or not suggestions. This is just an example. Very important. And then you could go into your individual account, and under there you might have some mutual funds. And maybe you want to, this is maybe for a home down payment. So it's maybe a little bit closer in your timeline than your retirement, which is maybe further out. So maybe in here you have a mutual fund that has a 60-40 mutual fund. It's just a little bit less risky, but that's going to be how you see it. And so you'll click on the account, you'll see the holdings, you can trade in those accounts, but they'll be separate. They're not going to aggregate your total so much, other than to give you a general net worth idea. I hope that answered the question.
Got it. Thank you, Lydia. Next question. What are the tax laws related to holding stocks for shorter periods of time versus longer periods of time?
Okay. So stocks, the gains in stocks, if you hold them for less than a year, that's considered ordinary income. If you hold them for more than a year, it's taxed at a lower rate, which is called a capital gains rate. So again, depending on, and if you're buying and selling within a retirement account, like a 401k or an individual IRA, a Roth IRA, you can defer those gains too. So you can buy and sell and not incur any gains. It's only in your taxable accounts, the accounts in your own name, where you're going to incur some of these taxes. Another way you'll incur taxes is if you have RSUs, for instance. That's all. So it's hard to avoid getting taxed at an ordinary income rate for that either, because it is considered part of your current compensation as they vest. So just to back up again, let's separate it into the kind of account. If you can buy and sell within a retirement account, you won't incur any gains. But the general rule of thumb is less than a year, it counts as ordinary income. More than a year, it's taxed at a lower rate, a capital gains rate.
Thank you so much, Lorraine. Next question. What are some qualitative factors that we should use to help determine which companies to include in our portfolio?
This is a good question. Lorraine, would you stay on with me for this one?
Yeah.
Because you also have good thoughts on these things. So some qualitative factors. When you look into a company, you want to understand the company's value. Because remember, the share that you hold is a piece of that company. So if you were to go, you might recall from the slide, but if you were to go onto Yahoo Finance or Google Finance and look up any company, you put in the ticker, it will give you some data. Price to earnings ratio is one of them. What else, Lorraine? Historical performance.
Yeah.
Data.
If it's qualitative, then you're trying to make a judgment as opposed to look at data and make an assessment of what the future prospects of a stock could be. So a qualitative assessment would be the quality of the management team. But, you're going to have to come up with some kind of a framework to say, is the management team, performing well, or is it not performing well? But that would be an example of a qualitative metric. Otherwise, we want you to be as objective and unemotional as possible about these investment decisions.
Thank you so much. So for our next question, we're wondering, why is it not advised to allocate a greater portion of your portfolio to real assets?
Lydia, do you want to start?
No, go for that one, Lorraine.
Okay, so real assets, first of all, there are two forms. In the form of a real estate investment trust, historically, and if you look at data over a very long period of time, real estate usually just keeps up with the rate of inflation. And I'm talking a long period of time, not, these kind of bubbles where you look and it's like, oh my God, the price of an apartment in New York just went down 10% or up 10%. Over time, we know, just because of supply and demand, usually real estate will increase, but not by as much as you think. Also, a real estate investment trust is liquid, but if you're going to say like buy an apartment, that's illiquid. So you won't be able to, sell it if you need the money in a short period of time. But anyway, keeping up with inflation is important, but you want to, but you're not going to get a lot of growth in that asset class.
Thank you. Now we have one final question. How does goals-based investing work? Do you have separate funds for each of your goals? For example, using a mutual fund to save for a car and an ETF to save for a house?
I can take this one with Lorraine if you want to stay on. It's been kind of nice to talk to you. But the idea for goals-based investing is that you want to, it's not so much that you would choose a different investment vehicle for each. It's more going to be the allocation that you choose for that goal. So remember, keep in mind, anything that's less than 5 years out, 3 to 5 years out, you're going to want to keep in cash, because and save for in cash, because just as the market could go up, it could go back down. And then you'd have to wait longer for that goal or find the money somewhere else. But for things like a home down payment, you would maybe just want to keep an allocation that was conscientious of when you would want to purchase the home. If you're talking 10 years, maybe it's a more conservative allocation. If you're talking 20, 30 years, maybe it's a more aggressive allocation. Anything to add on that one, Lorraine?
No, I think that covers it. We really want to separate goals into buckets of like short-term and long-term. And, obviously with your short-term goals, like saving for a down payment on a house, you would want to keep that more liquid. Your longer-term goals, you would build a more diversified portfolio to get you a more predictable growth over a longer period of time.
All right, perfect. So that's about all the time we have for Q&A. Thank you all so much for joining us today. And thank you to Lorraine and Lydia for your insight. As always, make sure to follow our socials for more engaging and digestible content as you guys continue your personal finance and investing journeys. All of these accounts are also linked in our description box below. Also, you guys should look out for a follow-up email with more resources that are going to enrich the topics that Lorraine and Lydia have covered today, as well as some information on the final event we will be holding in our personal finance series. Thanks again for being a part of the HerCapital community, and see you all next time.